You're wearing it right now. That cotton t-shirt on your back, it's not just fabric. It's the residue of a 400-year financial empire. Cotton, the crop that wasn't a crop. But here's what they don't tell you. Cotton turned human beings into collateral. For a million enslaved people weren't just labor. Their bodies secured the loans that built Wall Street. At its peak, 40 cents of every cotton dollar went straight to New York banks. British investors bought bonds backed by American slaves. Dutch widows funded plantation through instruments that looked exactly like the CDOs that crashed the economy in 2008. So what was cotton really? It was software, financial software. The white fiber was just the carrier. The real product was the paper, mortgages, bonds, futures contracts, and the world's first mortgage-backed securities. Today, a farmer receives less than 1% of what you pay for that t-shirt. The extraction hasn't stopped, it just changed addresses. From the looms of Mongol India to the algorithm-driven warehouses of China. This is the story of King Cotton's financial harvest. The story begins not in America, but in India. Because for most of human history, India was cotton. 23% of global GDP belonged to the Mughal Empire in 1700, while Britain progressed less than 3% at the same moment. The source of India's wealth wasn't gold or gems. It was fabric woven on millions of looms scattered across the subcontinent. Indian weavers had spent millennia perfecting cotton textiles until their muslins became so fine that people called them woven vein. A piece of Dhaka muslins could be drawn through a wedding ring. European aristocrats paid fortunes for Indian chains, calico, and painted cottons they couldn't produce at home. Europe faced a fundamental problem because it had nothing India wanted. The trade deficit grew so severe that Europeans called India the zinc of gold, where precious metal flowed from European mines and American conquests directly into India coffers, never to return. The Indian cotton trade operated through a system called Tatni, where weavers received advance payment from merchants to produce specific quantities of cloth, while remaining independent artisans. Autonomy was the key feature. The weaver owned their loom, controlled their time, set their quality standards, and could refuse orders or negotiate prices or switch between merchants whenever they chose. A Tatni weaver wasn't a wage laborer, but a craft entrepreneur. For centuries, this system generated extraordinary wealth for India while keeping European traders at a permanent disadvantage, as the balance of economic power tilted decisively toward the east. That changed when a revolutionary financial invention arrived on India's shore. And it wasn't a machine, it was a corporation. On the last day of 1599, Queen Elizabeth I signed a royal charter that created what would become the most powerful corporation in human history. The East India Company wasn't a trading firm in the modern sense, but a new species of financial organism that combined three revolutionary features never assembled together before. The limited liability came first, meaning shareholders could only lose their investment and never their personal estates. This transformed risk calculus entirely because investors could now fund dangerous voyages to the other side of the world, knowing their homes and savings were protected. Permanent capital came second. Unlike earlier trading ventures that dissolved after each voyage, the EIC was perpetual with stock that could be pulled and sold on the emerging London Exchange, creating liquidity that financed ever larger operation as shares become tradable assets. Sovereign powers came third, and this was the truly revolutionary feature because the EIC could declare war, negotiate treaties, coin money, and administer justice like a private company with the powers of a state. 1690 saw the EIC establish new headquarters at Subcontinent, a swampy settlement on the Hooghly River they named Fort William. The surrounding town will eventually become Kolkata. For decades, they operated within the existing Indian commercial structure as simply another buyer in the Datni system, competing with Indian merchants, Dutch traders, and French competitors. Everything changed in 1757. 8 hours was all the Battle of Plassey lasted. Yet, 3,000 company troops faced 50,000 soldiers of Nawab of Bengal. And the outcome was determined before the first shot was fired. Robert Clive had already secured the defection of Mir Jafar, a disgruntled general who commanded a third of the Nawab's army. When the battle began, Mir Jafar's forces simply stood and watched while the Nawab fled on a camel before being captured and killed days later. This wasn't military conquest in the traditional sense but a hostile corporate takeover, achieved through bribery rather than spurious force. 8 years later, in 1765, the EIC obtained the Diwani, the right to collect land revenue from Bengal, Bihar, and Orissa. This transformed the company from a merchant enterprise into a tax collection agency controlling the fiscal foundation of the Mughal Empire's richest province. Bengal's annual land revenue exceeded £2 million, more than the entire budget of the British government's civil administration. The price was staggering enough to reshape global power. What the EIC did with this power was grotesquely elegant. They used Bengal's own tax revenues to purchase Bengal's cotton goods for export. The colony paid for this on exploitation. The fossils extracted are not invested in India, contemporaries observed. They described this phenomenon as the investment, though the term was darkly ironic because it referred to using Indian wealth to buy Indian goods to enrich Bhutan. Economists later termed this the drain of wealth. Between 1757 and 1812, an estimated 500 million to 1 billion British pounds, roughly 50 to 100 billion in today's dollars, was drained from India in the largest peacetime transfer of wealth in human history to that point. Control of their revenues was only half the equation because the EIC also needed to control production. The Datni system gave weavers too much power. They could refuse orders, demand higher prices, or sell their superior pieces to competing buyers. The company needed a new system to break their independence. Into the Gomasta, the EIC's solution were Indian agents employed by the company managed weavers through a role that extended far beyond management. Their bondage was how the Gomasta system worked. Agents provided advances to weavers with obligations that could never be fully repaid. Weavers were forbidden from selling to anyone else. Quality was enforced through physical punishment. Prices were set unilaterally by company agents. Parliamentary testimony documented the abuses in detail. William Bull wrote in 1772 that weavers were frequently seized for their goods, and often when the weights used are lighter than the standard, the weight allowed the company is from 15 to 40% less than what they achieved. This represented a fundamental restructuring of market power. The independent artisan became a de facto employee. The negotiated price became a dictated quota. The quality premium became the quality punishment as the EIC achieved practical integration by transforming the labor structure itself. A parallel campaign is underway in Britain at the same time, protectionism. Parliament passed a series of laws collectively known as the Calico Acts between 1700 and 1721. These laws banned the import and wearing of printed or dyed Indian cotton fabrics within England. The stated purpose was protecting domestic wool and silk industries from Indian competition. But the actual effect was creating a protected incubator where nascent British textile manufacturing could develop without facing the world's most advanced producers. The Calico Acts became among history's most successful industrial policies because by eliminating competition from Indian finished goods, they forced technological innovation that produced machines capable of creating fabrics of comparable quality at lower costs. The spinning jenny appeared in 1764. Arkwright's water frame followed in 1769. Crompton's mule arrived in 1779. The power loom came in 1785. None of these machines emerged from pure ingenuity alone. British manufacturers developed them because they had a protected domestic market that allowed experimentation without being undercut by superior Indian goods. The IEC now faced an extraordinary situation because it had captured India's cotton production, drained India's wealth, and British machines could now replicate Indian fabrics at lower cost. Trade flow reversed entirely. India imported over 100 million yards of British cotton-based goods in 1840. By 1855, imports exceeded 2 billion yards as India, the original cotton kingdom, became a captive market for Lancashire's mills. A contemporary described this as the de-industrialization of India, where the world's leading manufacturing economy was reduced to an exporter of raw materials and an importer of finished goods. The looms of Dhaka fell silent. The rivers dispersed. Skills accumulated over millennia would lost within a single generation. While their EIC was conquering Indian cotton, a parallel financial machine was being constructed across the Atlantic. The American cotton economy wasn't just agriculture, it was a leveraged buyout of an entire continent. Roughly 100,000 bales of cotton came from the United States in 1800. By 1860, production had exploded to 4.5 million bales, nearly a 60-fold increase in 60 years. 3 separate technological revolutions powered this explosion. Each alone would have been transformative, but together they created an industrial miracle built on human suffering. The first revolution was the cotton gin that Eli Whitney invented in 1793 to solve the critical bottleneck in cotton processing. Short staple upland cotton could grow throughout the American South, but its seeds were entangled in the fiber and nearly impossible to separate by hand. A skilled worker could clean approximately 1 pound of linen per day. Whitney's gin changed the mathematics entirely. A hand-cranked version could produce 50 pounds of clean cotton per day. A water-powered gin could produce 1,000 pounds. The largest steam-powered gins by 1860 produced 2,500 pounds per day. Processing productivity increased 2,500-fold. The gene didn't just remove a bottleneck, it annihilated it completely. The second revolution was biological. The Petit Gulf cotton variety, a planter in Rodney, Mississippi, developed a new cotton cultivar in the 1820s, with dramatically improved characteristics including larger bolls, longer and stronger fibers, denser plant growth, and most importantly, cotton that could be picked faster. Traditional Georgia upland cotton allowed an experienced picker to harvest approximately 40 pounds per day. Petit Gulf cotton pushed picking rates to 120 to 150 pounds per day. This wasn't a machine improvement but a biological one that increased human picking productivity by nearly 400%. This productivity gain explained a paradox that puzzles contemporaries. Cotton prices fell steadily from the 1830s onward, yet slave prices rose continuously during the same period. Unit economics provides the explanation. Even as the price per pound fell, the pounds per person rose faster. Total revenue per enslaved worker increased even as profit margins per pound compressed. The productivity explosion made slave labor more valuable, not less. The third revolution was thermodynamic, steam power. Steam technology transformed cotton into distinct applications. Steam power gains a low processing capacity to scale beyond the limits of water power, so planters no longer needed to locate near a river. The steamboat revolutionized logistics even more significantly. Before steam, moving cotton from the interior to coastal ports required slow, expensive overland transport. The steamboat reduced freight costs by over 90%. The New Orleans bridged its namesake city from Pittsburgh in 1811. 187 steamboats operated on the Mississippi River system by 1814. Over 3,500 steamboats connected the cotton frontier to global markets by 1860. This logistics revolution meant cotton could be profitably grown ever deeper in the continental interior. The Cotton Kingdom expanded westward at the speed of steam. These three revolutions created the physical capacity for the Cotton Kingdom. The physical capacity required financial infrastructure, and the financial infrastructure of the Cotton Kingdom was built on human bodies. Enslaved people in the antebellum South were not merely labor but the primary form of collateral. The assets against which the entire credit system was secured. Southern bankers often viewed an enslaved person as a superior asset to land. Land in the frontier district was abundant and foreclosed plantation might find no buyers for years. But enslaved people were mobile capital that could be seized, transported to the active slave markets of New Orleans or Natchez, and converted to cash within weeks. This liquidity made enslaved people the favorite collateral for bank loans throughout the antebellum period. Research in bank archives, including those of the Bank of Kentucky and the Second Bank of the United States, reveals that these institutions directly issued commercial paper to slave traders, secured by the bodies being trafficked. The most sophisticated financial innovation of the Cotton Kingdom was the Plantation Bank, which effectively created the world's first slave-backed securities as an American version of the Dutch negotiating. The Citizens Bank of Louisiana, the Consolidated Association of the Planters of Louisiana, and the Union Bank of Louisiana were not standard deposit banks, but credit unions for the planter class, designed to monetize illiquid assets. The structure worked in three steps. First, lenders subscribed to bank stock not with cash, but by executing mortgages on their land and their enslaved workforce. A lender might pledge a plantation worth $20,000 and 30 enslaved people worth $25,000 to purchase $45,000 of bank stock. Second, lender-dominated state legislatures passed acts pledging the faith and credit of the state to guarantee the bank's bonds, converting a private mortgage pool into quasi-sovereign debt. Third, the bank bundled these mortgages and issued bonds backed by the pool and the state guarantee. These bonds were marketed in London, Amsterdam, and Paris by prestigious merchant banking houses like Baring Brothers and Hope and Company. As historian Edward Baptist noted, the purchase of one of these bonds was really the purchase of a completely commodified slave. Not a particular individual, but a tiny percentage of the income flows derived from each one of thousands of slaves. European investors escaped the risk of slaveholding, including mortality, flight, and rebellion, but they captured the yield all the same. The financial instruments appeared the moral links, turning blood into paperwork. Single statistic reveals the dominance of cotton monetized illiquid assets. In American finance, the Northern Cut, contemporaries and historians estimate that Northern merchants, bankers, insurers, and shippers captured approximately 40 cents of every dollar paid for southern cotton. Multiple charges compose this revenue stream. Factorage commissions of 2.5% on sales, freight and shipping on northern vessels, marine and fire insurance from New York and Hartport companies, interest on advances from northern banks, and exchange premiums from northern currency dealers. The South produced the cotton, and the Wall Street captured nearly half the value. New York's dominance was such that it was described as an extension of the South. The city's traffic rise to rival London as a financial center was built directly on the volume of the cotton trade and the surfacing of southern debt. The entire system, including the leverage, the slave-backed bonds, and the wildcat banknotes, was predicated on one assumption: the price of cotton remaining high. That assumption failed in 1837. The bubble burst not in Mississippi, but in London when the Bank of England raised its discount rate from 3% to 5% in 1836 and restricted credit to American trading houses. Transmission was immediate. British merchant banks curtailed credit to American houses. New Orleans cotton factors could no longer get advances. The prominent firm Herman, Briggs and Company failed when their bills were protested in London. They called in loans from planters who defaulted, causing banks holding discounted bills to fail. Nicholas Biddle launched an audacious scheme to corner the cotton market in a desperate bid to stem the panic, using the funds of the newly state-chartered United States Bank of Pennsylvania to purchase millions of dollars of cotton directly, ship it to Liverpool, and withhold it from the market to force prices up. The scheme collapsed in 1839, then a bumper crop and continued tight money in Europe crashed price. Biddle's bank, holding massive inventories of depreciating cottons, suspended payments before eventually liquidating in 1841. Mississippi repudiated $5 million in Union Bank bonds by simply refusing to pay foreign bondholders and declaring the debts unconstitutional, raising American credit in Europe for a generation. The Cotton Kingdom had experienced its first systemic financial crisis. It would not be the last. While the American Cotton Kingdom was leveraging itself into crisis, Manchester and Liverpool were constructing the financial infrastructure that would dominate the global cotton trade for a century. The twin cities functioned as a single financial organism. Liverpool was the gateway, the port where cotton arrived and paper was traded. Manchester was the engine, the industrial heartland where fiber became fabric and profits accumulated. Understanding the 19th century cotton trade requires understanding Liverpool's transformation from a physical marketplace into the world's first modern commodity exchange. Cotton trading was physically tied to the goods in the early decades of the century. Merchants and spinners congregated on the exchange flags, the open square behind Liverpool Town Hall, where the pavement was frequently dusted with the white fluff from cotton samples. Quality was determined by touch and sight in a tactile sensory marketplace. The system created high transaction costs. A spinner from Manchester would travel to Liverpool or employ a specialized buying broker to inspect bills in the warehouses. Every transaction required physical inspection. More critically, this system offered no mechanism for hedging risk. If cotton prices collapsed while a cargo was at sea, the importer bore the full loss. If a mill owner secured a contract for cloth but couldn't guarantee the price of raw material 3 months hence, he faced ruin. The market needed to separate the financial trade from the physical trade. The solution was standardization. The Liverpool Cotton Brokers Association, established formally in 1841, developed a rigorous classification system that became the global language of the trade. Middling American cotton served as the central standard. Grades like good middling and fair rank above it, low middling and ordinary rank below. The standardization allowed for trading on description, where a spinner no longer needed to see the cotton. He merely needed to buy 100 bales of middling ortolans. A standard price differentials applied if the delivered cotton was of higher or lower grade. Creating middling was as significant as the steam engine because it turned cotton into a financial asset, akin to a bond or a currency, where the specific bale became irrelevant and only the grade mattered. Standardization enabled the next innovation, the hedge. Before the telegraph, information was power. Speculative syndicates used carrier pigeons to relay crop reports from ships stopping at Queenstown in Ireland, gaining a 4-hour trading advantage before official mail reached Liverpool by coach. The Rothschilds famously maintained pigeon networks for continental intelligence, and cotton speculators adapted the model. A bird arriving with news of a crop failure could make a fortune before the telegraph made such advantage obsolete. Following the volatility introduced by the American Civil War and the speed of the transatlantic telegraph cable, a merchant named John Rue developed their hedging system in the late 1860s. Rue recognized that merchant importing cotton faced price decline risk during the transit period. To neutralize this, when the merchant bought physical cotton in New Orleans, he would simultaneously sell a futures contract in Liverpool for the same quantity. The market price fell. He lost money on the physical cotton but made a compensating profit on the short futures contract. If prices rose, the physical cotton gained value, offsetting the loss on the futures. This effectively locked in the merchant's profit margin and eliminated absolute price risk. This innovation fundamentally altered banking. Banks became far more willing to lend against hedged cotton. Cotton bills backed by hedge inventory became too cheap. Securities where leverage in the trade expanded dramatically. The volume of speculative trading they called paper cotton dwarfed the physical trade by the 1870s. The Liverpool Cotton Association developed a clearinghouse mechanism requiring brokers to mark positions to market and settle differences in cash immediately. Liverpool had become the constitutional monarch of the global textile economy. While Liverpool provided the marketplace, Manchester provided the banking network where mills generated capital that banks recycled. Time was the fundamental financial challenge of the cotton trade. A Manchester spinner had to pay for cotton upon shipment. Processing took 2 to 3 months. Selling finished goods to India or China often involved credit terms of 3 to 6 months. This created a credit lag of 4 to 9 months, where capital was locked in inventory. Without bridge financing, the entire industry would grind to a halt. The solution was the bill of exchange, essentially post-dated checks that circulated as currency. When a Manchester merchant bought cotton, he accepted a bill of exchange drawn by the American seller, promising payment in 90 days. The American seller, needing immediate cash, would discount this bill to a New Orleans bank, which would send the bill to Liverpool for rediscounting. The bill might change hands 10 times before maturity, with each endorsement adding a layer of security. The bill on London became the gold standard of international trade. But in the cotton sector, it was effectively a bill on Manchester and Liverpool, where the commercial reputation of the cotton lords was monetized through these paper instruments. The bill system created global financial integration, but it also created systematic risk. During the Panic of 1837, the collapse of credit markets threatened to bankrupt the major West India and cotton merchant houses. The Bank of England organized a loan of £1.5 million to the West India merchants to provide liquidity during the crisis. These interventions were among the first instances of central bank acting as lender of last resort to the private sector, The techniques developed to stabilize the cotton economy became the cornerstones of modern central banking. The cycle repeated during the Panic of 1857, when panic originated in the American railroad bubble but transmitted instantly to Liverpool via cotton bills. Manchester's district banks played a key role in keeping local mills liquid when London credit markets ceased. The cotton trade had become too big to fail because its integration into British financial infrastructure meant that a crisis in Mississippi was the crisis in Manchester. The triangle of debt bound the continents. 80% of the cotton consumed by British mills came from American salt in 1816. Lancashire depended on American slavery for its industrial existence. This dependency was not unknown. The Liverpool Chamber of Commerce had warned repeatedly about the danger of relying on a single supply source. Their warnings proved prescient. Confederate artillery opened fire on Fort Sumter on April 12, 1861. The American Civil War had begun. Initially, the war seemed almost welcome in Lancashire. A massive overproduction in 1859 and 1860 had cluttered warehouses with unsold cotton and clothes. Mills were operating on short time. Merchants held inventory they couldn't sell. Some thought the blockade might actually help by restricting supply and raising prices. They were catastrophically wrong. The cotton famine struck Lancashire with devastating force. By late 1862, over 400,000 workers were unemployed, while 60% of the operative population was in distress. The bankruptcy pattern was revealing. The Manchester model of textile financing relied heavily on leveraged credit where small mill owners, the small masters, borrowed to buy cotton against anticipated sales. When raw material disappeared, they faced margin calls they couldn't meet. Failure rates were brutal. 8 to 7 cotton firms failed in 1861 with liabilities of £1.5 million. By 1863, larger firms were collapsing, including J.W. Fenton and Company and Smith and Kay, dragging down connected merchants and suppliers. The banking system survived, and here's what it gets strange. Existing cotton inventories actually appreciated as scarcity increased. Banks holding cotton as collateral found their security strengthening even as the economy collapsed. The shortage that impoverished workers and enraged speculators. Middling Ortland's cotton rose from approximately 7 pence per pound in 1816 to 31 pence by 1864, more than a fourfold increase. Suffering workers required relief, and this triggered an unprecedented experiment in public welfare. The poor law system, designed to handle rural poverty, was overwhelmed by industrial-scale unemployment. Central government was forced to intervene. The Public Works Act of 1863 authorized municipalities to employ the unemployed on infrastructure projects funded by government-guaranteed loans. One of the earliest examples of Keynesian-style counter-cyclical spending decades before Keynes. Private charity mobilized on an epic scale. The Lancashire and Cheshire Operatives Relief Fund raised over £500,000. The Mansion House Fund in London contributed additional substantial sums. Over 100,000 operatives were employed on public works at its peak, building roads, improving sewers, and landscaping parks as skills developed on cotton looms were applied to civic improvement. Relief came with conditions. The workhouse desk remained. Recipients had to submit to institutional supervision. Families were sometimes separated. Victorian distinction between deserving and undeserving poor persisted even in this extremity. Not all workers accepted their fate quietly. The Stoley Bridge riots erupted in March 1863. When workers attacked the portal guardian smashed house windows and demanded outer relief, challenging the myth of the sublime sufferer. The narrative of Lancashire workers numbly enduring for the Union cause. Britain could not wait for the war to end. It ended new sources of cotton immediately. Three potential suppliers existed: India, Egypt, and Brazil. Each had limitations, but desperation transformed marginal producers into strategic assets. India's moment arrived, though Indian cotton had always been considered inferior to Suvat cotton, with shorter fiber and more contamination than American uplands. Lancashire mills were designed for American cotton and resisted stretching. Necessity forced adaptation. Engineers modified spinning machinery to handle the shortest red staple. Wet spinning techniques were developed. Quality standards were relaxed. This crisis justified massive infrastructure investment. The Indian Railway Network, funded through the guarantee system, where the colonial government guaranteed 5% returns to investors, suddenly became strategically essential. The Great Indian Peninsula Railway connected Bombay to the cotton districts of western India. Cotton that previously moved by bullock cart could now move by rail. The Bombay share mania of 1861-65 saw speculative investment pour into transportation and banking stocks. An estimated £81 million sterling flooded into the Bombay economy between 1861 and 65. At the center of this frenzy was Premchand Chen, a broker who became king of the Bombay markets, floating dozens of speculative ventures including the Bet Bay Reclamation Company, where shares, with face value of 5,000 rupees, traded at 50,000 rupees at the mania's peak. And the bubble burst, Bank of Bombay collapsed, the only presidency bank in British Indian history to ever fail. The speculative fever that cotton wealth ignited destroyed a generation of indigenous capital. The boom contained its collapse. The financial crisis of 1865 and 66 devastated Bombay. The Bank of Bombay failed. Cotton prices crashed as American supplies returned. Fortunes made in the mania evaporated. Egypt followed a similar trajectory to a similar fall. Khedive Ismail saw opportunity in Lancashire's desperation and embarked on a massive program of hydraulic engineering, extending perennial irrigation into regions previously dependent on the Nile's annual flood. Cultivated cotton acreage in Egypt more than doubled between 1862 and 1873. Long-staple Egyptian cotton commanded premium prices in Liverpool, while the Khedive's personal revenue soared. The boom had a dark underside. Census data reveals that Egypt's rural slave population tripled between 1848 and 1868, rising from 40,000 to nearly 145,000. Landowners flush with cotton wealth purchased enslaved people from East Africa toward the new baronial estates, proving that modernization and bondage could advance together. The irrigation projects required loans. European banks, particularly British and French, extended increasingly on roads created with interest rates exceeding 10% and loans secured against future tax revenues. Egypt's national debt exploded from £3 million at Ismail Pasha's ascension to over $90 million by 1876. That's roughly $12 billion in today's dollars. By that year, debt surfacing consumed two-thirds of state revenue and half of all export earnings. Egypt was building a debt trap disguised as development. And within 2 decades, that trap would spring shut with devastating consequences, leading directly to British military occupation in 1882. The Suez Canal, completed in 1869, cemented the new trade routes. Cotton from India and Egypt could now reach Liverpool faster and cheaper than ever before. The American monopoly was permanently broken. The cotton famine didn't just disrupt supply chains, it restructured global geography. In Brazil, the transfer was human. Emperor Dom Pedro II actively recruited defeated Confederate landers, offering subsidized passage and cheap land. Several thousand Confederados settled near Sao Paulo, establishing communities like Tilados Americanos, now called Americana. They introduced the moldboard plow, modern sowings, and superior seed varieties, transferring the agricultural expertise of the antebellum South to a new continent. The plantation system that slavery built was exported when slavery ended. The volatility of Civil War era demanded new financial instruments. The American response was the cotton futures market. The New York Cotton Exchange was founded in 1870 to create a centralized, regulated marketplace where merchants could buy or sell cotton or delivery at a future date. This was the invention of the future, a mechanism that allowed participants to lock in prices, transferring risk from merchants seeking stability to speculators seeking profit from volatility. The telegraph had fundamentally altered their relationship between information and goods. After the transatlantic cable was successfully laid in 1866, price information traveled faster than cotton for the first time in history. Rather than stabilizing markets, this initially exacerbated volatility. Information about crop failures or political instability spread instantly, causing violent synchronized price swings in New York, New Orleans, and Liverpool. Merchants needed tools to manage this new reality. The standard futures contract evolved into a highly specific financial instrument. The unit of trading was 50,000 pounds, approximately 100 bales. The basis grade was middling 7/8 inch wide. Prices were quoted in cents per pound to 100 precision. Settlement was by warehouse receipt, and physical delivery was rare because contracts were settled by exchanging receipt or offsetting positions. Cotton had become paper cotton, vertible without ever seeing a bowl. The futures market created new opportunities and new temptations. The most infamous attempt at manipulation was the Sully Corner of 1903 through 1904. Daniel Sully was a former soap salesman turned speculator who correctly identified a shortage in the cotton crop in 1903 and began aggressively buying futures contracts, effectively joining a bull pool with other speculators. His strategy was to try the market by purchasing all available futures so that anyone who had sold short would have to buy from him at any price. Sully's buying pressure drove cotton from approximately 8 cents per pound to an unprecedented 17.55 cents. By February 1904, he accumulated a paper fortune estimated at $10 to $15 million, over 300 million in today's money. High prices devastated textile mills. British spinning mills closed or ran on short time because they couldn't afford the artificially inflated cotton. The corner collapsed on March 18, 1904 when Sully announced he could no longer meet his margin calls. In the 20 minutes following the announcement, cotton prices crashed from approximately 15 cents to 12.6 cents, dropping 240 points in minutes. Over 750,000 bales traded in the panic as brokers liquidated Sully's position. He lost his entire fortune in what confused Wall Street. The Sully Corner demonstrated the double-edged sword of financialization. While futures allowed hedging, they also allowed a single individual to hold the global textile industry hostage. The Great Depression revealed the limits of private markets and the necessity of government intervention. Global demand for textiles evaporated following the 1929 crash. But cotton is biological and farmers had already planted their 1930 crop based on 1929 price signals. This illustrates what economists call the cobweb theorem, a vicious cycle where price volatility increases rather than dampens over time because farmers can't adjust quickly enough. High prices in 1927 through 29 encouraged record planting. The demand shock of 1929 left a supply glut that crashed prices. The perverse response followed. Faced with lower prices, individual sharecroppers and tenant farmers tried to increase production to maintain gross income, planting more and creating an even larger glut in 1931 and 1932. The price collapse was catastrophic. Cotton prices fell from 29 cents per pound in 1923 to 5.66 cents in 1931. An 80% decline. The rural banking system collapsed. The entire Southern credit structure was built on the cropland system. When cotton fell from 18 cents to 5 cents, the collateral backing millions of loans evergraded, causing thousands of rural banks to fail and cutting off the furnish that sustained sharecroppers through the winter. This financial collapse forced demographic revolution. The push factor of the cotton crash was a primary driver of the Great Migration, the movement of millions of African Americans from the rural South to the industrial North. The failure of private markets led to the Agricultural Adjustment Act of 1933, when the government became the market. The blow-up campaign of 1933 ordered the destruction of 10 million acres of growing cotton, 25% of the crop. Mule drivers struggled to force their animals to trample the crops they had been trained to avoid. Brutal logic was supply and demand. Reducing supply was the only way to raise prices. The most enduring innovation was the non-recourse loan, where the Commodity Credit Corporation would lend farmers money against their cotton at guaranteed loan rates. If market prices rose above the loan rate, farmers could sell and repay. If prices fell below, farmers could forfeit the cotton to the government and keep the money. The loan rate became the de facto floor price. No rational farmer would sell cotton for 8 cents when the government would lend them 10 cents for it. This mechanism transferred downside risk indirectly from the farmer to the taxpayers. Wartime demand had pushed support prices to 90% of parity by 1942. By 1943, the government effectively controlled the cotton market in the common economy. Cotton, once the king of the South, had become a ward of the state, with its price determined not by rain in Mississippi, but by the stroke of a pen in Washington. The mid-20th century brought the final transformation of American cotton production. The mechanical picker. Commercial mechanical cotton pickers introduced by International Harvester in the 1940s fundamentally altered the unit economics of production by shifting costs from variable labor to fixed capital. For a century, the cotton economy had depended on the furnish system where planters extended credit to sharecroppers for food and supply throughout the year, secured by the future crop, while sharecroppers provided the labor-intensive harvest. The furnish was not merely a loan, but a mechanism of labor retention. The harvest window was narrow at 6 to 8 weeks. Planters needed a massive workforce available for the critical period. Credit kept workers tied to the land year-round. The mechanical picker eliminated this need. Hand picking cost approximately $45 per bale in the 1949 season, while machine picking cost approximately $26, a net advantage of nearly $19 per bale. The capital requirement was substantial. An international harvester picker cost approximately $9,500 in 1915, when the average sharecropper family earned less than $1,000 annually. This creates a break-even threshold. Only single-row pickers require roughly 150 to 200 acres to justify investment. A 40-acre sharecropper plot was an economic anachronism. Economic reality forced land consolidation. Planters evicted tenants not just to save labor costs, but to amalgamate small plots into tracts large enough for machine operations. Displacement was massive. Over 4 million people moved from the rural South between 1940 and 1970. In cotton counties of Arkansas, Louisiana, and Mississippi, net outmigration reached 350,000 in the 1950s alone. Federal policy accelerated the mechanization. The extension of minimum wage to agricultural workers in the 1960s raised labor costs. The end of the Bracero program in 1964, which had brought temporary Mexican farm workers to American fields for over 2 decades, eliminated the supply of cheap gas labor. Farmers who had hesitated to mechanize were forced to invest immediately. The machine became the only hedge against wage inflation. The numbers tell the story. U.S. farmer employment was 11 million workers with 1.6 million tractors in 1940. By 1970, employment had collapsed to 4.5 million, while the tractor fleet grew to 4.6 million. The proportion of cotton harvested mechanically rose from 6% in 1949 to 96% by 1969. The agricultural sector had successfully liquidated its dependency on human muscle. Mechanization created a new problem: surplus. U.S. cotton production soared even as domestic consumption stagnated. Synthetic fibers were eroding cotton's market share. The rise of rayon, nylon, and polyester meant less demand for the natural fiber. The Commodity Credit Corporation found itself holding millions of unsold bales. Storage costs mounted. Global prices were depressed by the American overhang. Simultaneously, the Cold War required economic stabilization of East Asia. Japan, devastated by World War II, and South Korea, wrecked by the Korean War, needed raw materials for reconstruction but lacked the dollars to buy on open markets. Public Law 480, also known as Food for Peace, solved both problems simultaneously. The mechanism was elegant. The United States shipped surplus cotton to Asian nations. Their achieving government paid in local currency deposited into U.S.-controlled accounts. These counterpart funds were then lent back to finance economic development projects. Asian textile manufacturers achieved high-quality American cotton without spending scarce dollars. The U.S. offloaded surplus while building Cold War allies. Japan was the largest customer for U.S. cotton in 1955. By 1951, Japan had regained its status as the world's largest exporter of cotton textiles, fueled by American raw material. As Japan moved up the value chain to electronics and automobiles, the textiles patent passed to South Korea and Taiwan. Korean spindle capacity grew from negligible in the 1950s to over 3 million by 1980. The irony was unmistakable. The United States had financed the creation of the very industries that would eventually decimate its own domestic textile manufacturing. The mechanical cotton picker didn't just harvest a crop. It harvested a social order by severing the link between labor and land in the West. And through the surplus it generated, it helped forge the link between labor and factory in the East. The late 20th century brought a new form of enclosure, not of land, but of genetics. Monsanto introduced Bulgari cotton in 1996, the first commercially available genetically modified cotton containing genes from Bacillus thuringiensis. The seed was no longer just biological material, but proprietary software. For 10,000 years, the seed had been the farmer's capital, a self-replicating asset harvested from the previous season and stored for the next, where the cost was effectively the opportunity cost of not selling that portion as grain. Biotechnology inverted this structure. The seed became a delivery vehicle for licensed technology that could not legally be saved and replanted. The farmer didn't own the reproductive capacity, only the commodity value of one season's harvest. The price shift was dramatic. Seed prices rose by 463% between 1990 and 2020, while general commodity prices rose 56% during the same period. Seed price inflation outpaced commodity inflation by a factor of 8. Extraction occurred through technology fees and trade value. In India during the early adoption phase, BT cotton seeds cost approximately 1,600 rupees per packet, about $40, nearly 4 times conventional hybrid prices, with most of that premium going directly to Mexico Monsanto. The industry consolidated into the Big Four: Bayer, Monsanto, Corteva, ChemChina, Syngenta, and BASF now control over 60% of the global proprietary seed market. In U.S. cotton specifically, the 4 largest firms control 91% of seed sales. The collision between high-input agriculture and smallholder reality is starkest in India's Vidarbha region. Vidarbha is characterized by rain-fed agriculture where yields depend on the monsoon. The mismatch between expensive GM seeds and volatile rainfall creates financial fragility. The debt cycle operates predictably. At planting time, farmers lacking cash approach input dealers for credit because formal banks often refuse. Dealers charge implicit interest rates of 24 to 36%. With credit tied to crop sales, forcing farmers to sell back to the dealer at below market rates. ET cotton performs well with adequate moisture, but in drought, the expensive seeds fail just like cheap ones while the debt burden is far greater. A single season of drought can push a smallholder into a spiral where new loans are taken merely to service interest on old ones. The high upfront costs of the GM model amplify rather than reduce financial risk for rain-fed farmers. Burkina Faso provides a contrasting failure mode where BT cotton succeeded agronomically but failed commercially. The G introgression produced shorter staple fiber with lower ginning ratios. In 2016, the Interprofessional Cotton Association phased out BT cotton entirely and sold $280 million in compensation from Monsanto. Modern seed companies operate like technology platforms. By owning the seed, the tree, and the accompanying chemical conglomerates create closed-loop system where farmers cannot easily mix inputs from different suppliers. The legal architecture reinforces this control. Technology stewardship agreements explicitly prohibit saving, cleaning, or replanting seeds and grant companies the right to inspect farms and records. The Supreme Court's 2013 Bowman v. Monsanto decision confirmed that patent exhaustion does not permit farmers to replant patented seeds. The seed, once a renewable public good, has become a licensed service requiring annual rental payment. The 21st century brings the final chapter of value extraction, fast fashion. The cotton farmer receives less than 1% of the retail price of a garment today. Analysis of a $30 hoodie shows the brand earns approximately $4.50 in net profit, while the cotton farmer's net income is 21 cents. The brand earns 20 times more than the farmer who grew the fiber. The farmer receives less than 1% of the retail price. This extreme compression results from two parallel revolutions: the velocity revolution and the global fragmentation of production. The Inditex model pioneered just-in-time retail for fashion where Zara stores achieved mule shipments twice weekly. The company commits to a small fraction of seasonal inventory in advance, leaving malls open to buy to chase trends in real time. The result is negative working capital. Inventory turns over faster than supplier payment terms. The retailer collects cash from customers weeks before paying factories. The float is an interest-free loan from suppliers. Shine, the China's fast fashion giant that's become the world's largest clothing retailer, takes velocity to its limit with production runs of 100 to 200 units. Micro batches test consumer response. Successful styles trigger automatic reorders. Failures are written off as minimal losses. The bullwhip effect transfers volatility upstream. Just in time at the retailer means uncertainty at the mill and chaos at the farm. A 5% retail demand fluctuation can translate into 40% swings in raw cotton orders. The fundamental problem is temporal. Retail cycles operate in days while agricultural cycles operate in months. Cotton farmers plan in April for or October harvest while retailers commit weeks ahead. The farmer and spinner hold the buffer stock that allows retailer agility. They absorb the uncertainty that their retailer shares. The waste dimension completes the picture. The industry produces between 2.5 and 5 billion unsold garments annually. When domestic clearance fails, the global south becomes the disposal solution as 15 million items enter Ghana's Cantonment market weekly, with 40% arriving as waste. If brands paid true disposal costs, the unit economics of $10 t-shirts would collapse. The profitability of fast fashion depends on zero-cost disposal in markets like Ghana and Chile's Atacama Desert. The future of cotton lies not in the fiber itself, but in data, carbon, and water. The industry is transitioning from commoditization to differentiation. For a century, global trade infrastructure stripped identity from cotton to facilitate liquidity. A bale from Texas was interchangeable with one from India. This model is inverting as regulatory pressure, consumer demand, and financial risk assessment force companies to account for what economists call externalities, the hidden costs of environmental degradation and labor exploitation that were never on the balance sheet before. Blockchain traceability platforms like Textile Genesis and FiberTrace are converting trust into a transactable asset where digital tokens track fiber from farm to retail, preventing the double spending of sustainability certificates. Capital markets are repricing risk. Sustainability-linked loans offer interest rate discounts of 5 to 25 basis points for borrowers meeting ESG targets, or multiple billion-dollar facilities. This translates to millions in annual savings. Carbon credits represent a new harvestable commodity. Regenerative practices can sequester 0.2 to 1.5 tons of carbon per hectare annually. At prices of $30 to $80 per credit, this adds material revenue per acre. Water is the ultimate constraint. The Aralti disaster demonstrates the long-term cost of ignoring hydrological externalities. Once the world's fourth largest lake, it shrunk by 90% due to Soviet-era cotton irrigation. The economic destruction included 40 to 60,000 lost fishery jobs and multi-generational public health burdens. Modern water markets in Australia's Murray-Darling Basin now price this risk explicitly. Tradable water entitlements fluctuate with drought, bifurcating land values based on water security. The farmer of the future is not just the cotton grower but the carbon farmer, a water steward and a data generator, with the physical bale becoming merely the carrier for higher value digital assets. 4 centuries, 3 continents, 1 fiber. Cotton built the Mughal Empire and destroyed it, financed the Industrial Revolution and the slavery that fed it, created the world's first futures markets and the first mortgage-backed securities. It triggered the largest peacetime wealth transfer in history, caused the greatest humanitarian crisis in 19th century Britain, justified the occupation of Egypt that lasted 70 years. It displaced 4 million American sharecroppers, financed the industrialization of Asia, created debt traps that persist to this day. At every stage, the financial innovation was more sophisticated than the agricultural one. The cotton gin was simple mechanics. The slave-backed one was financial engineering. The futures contract was mathematical abstraction. The gin pattern was legal alchemy. The pattern repeats. Physical productivity improves, prices fall, financial instruments capture the value created, the actual producer achieves less. A Vidarbha farmer earns 21 cents from a $30 hoodie today, but in 1830, a Mississippi planter might keep 60 cents on the cotton dollar after factor commissions. The extraction has intensified, not diminished. The new cotton economy promises transparency and sustainability, but blockchain traceability serves brand risk management first and farmer welfare second. Carbon credits flow through aggregators who capture significant margins. ESG loans benefit borrowers with existing scale and sophistication. The pattern suggests the farmer will not capture the value of the new cotton economy. Cotton's 4th century journey reveals a persistent truth about global capitalism. The most valuable crop is never the physical commodity, but the financial instrument built upon it. From the Dani weavers of Bengal to the algorithm-driven warehouses of Shine, the story of cotton is not the story of a plan, but the story of capital's infinite ingenuity in converting labor into abstraction, risk into premium, and suffering into return. The looms of Dhaka fell silent 2 centuries ago. The spinning mills of Lancashire closed a century later. The sharecropper cabins of Mississippi are ruins, but the financial architecture built on cotton remains. The futures exchange, the commodity trading houses, the credit instruments, the Lego frameworks. The white coat has been harvested. The financial harvest continues.